Best 1031 exchange investment. So you sold your real estate investment property and now you have to make a decision. What do I reinvest in? Well, 1031 exchange can be a great option for you to find a real estate property that you can defer tax into and compound long-term returns. Not all 1031 exchange investments are equal. If you're looking for cash flow, appreciation, and a hands-off investment, then I'll walk you through a couple different options here through this video. If you're doing a 1031 exchange, have you been overwhelmed with the different choices that are out there for you? I'll walk you through some of the top investment strategies so you can make an educated decision on meeting your long-term real estate goals and executing on the 1031 successfully. By the end of this video, you're going to know the ins and outs of a 1031 exchange, what assets to invest in, and how to utilize your strategy of long-term growth, cash flow, tax deferral, and wrap it all together in a bow so you can focus on finding the right property for you and checking all the boxes to execute on this powerful strategy in real estate that helps you defer taxes long-term. So why would you do a 1031 exchange? Well, first, there has to be a reason that you're selling the property. And typically it's you maximize value, you're tired of managing it, there's too many long-term improvements or repairs, or the tenants are such a pain in the butt or they're leaving the property that it's time to exit that asset and you're looking for a new asset to invest in. Ideally, the new asset will have cash flow, appreciation, solid long-term tenant stickiness where they're going to stay there and continue to pay, long-term rent growth, and low capital expenditures, meaning low re-improvement costs or deferred maintenance that you're going to need to reinvest in that property. Also, you're probably looking for a superior location that's going to continue to go up over time in property value and in rents. So I'm going to break down a chart here saying what are the investor's goal and then what would be the best strategy on the other side for it. So the investor's goal is to maximize cash flow, then triple net properties, mobile home parks, self-storage, small bay industrial. That's going to give you the highest cash flow for you. Hands-off investing, triple net, DSTs, and tenants in common. Long-term appreciation, value-add multifamily, value-add mobile home parks, value-add commercial properties, value-add apartment complexes. Portfolio consolidation, looking for larger single-tenant properties like industrial properties or retail properties. The investor wants to exit the active management. DSTs, triple net, tenant in common, and a co-GP structure, which is investing into real estate funds. We'll get into that and how to do that in another video, but there is a way to 1031 exchange into a real estate fund. Investor goal, tax shelter plus the passive gains. The investor is looking for a tax shelter and passive losses. This last strategy, you may not need to 1031 exchange, and depending on what the tax law is in 2025 of reinstating bonus depreciation, if it comes back to 100% bonus, then the investor may want to pick up the gain on the sale and then take those proceeds and invest in a larger property, accelerating depreciation on the new asset, and it could possibly offset all of the gains that they incurred from the previous asset that they sold. But as of right now, bonus depreciation is not in effect. It's down to 40%, so that strategy would not work in this climate in 2025. So what investment options qualify for a 1031 exchange? Well, the key term here is like-kind property. What that means is rental real estate or investment real estate for rental real estate and investment real estate. So you can buy any type of property, single family, short-term rental, commercial, industrial, retail, apartments, medical office, mobile home parks, self-storage, gas stations, data centers. You can buy any type of commercial real estate, even land, as long as it's used for investment or rental purposes. Now, also, if your business uses that property and for business purposes and you're buying real estate for business purposes, that qualifies as well. So investment for investment. Now, you don't need to match up the same types of properties. You don't need single family for single family. You can use any type of rental real estate for any other type of rental real estate. What doesn't qualify is primary residence, a second home that you use the majority of the time, more than 14 days a year. A fix or flip property that you're buying and then selling quickly. You cannot 1031 exchange into another property that way. Typically, you want to hold the property for at least a year, or if you had the intent to flip, it does not qualify for an exchange, especially if you're a dealer or someone that does that on a consistent basis. You probably will get audited. Some of the more unique asset classes I've seen are hotels. Now, you have to be careful because they are operator driven. So You cannot exchange into a business of a hotel, but you could buy the hotel property and have an operator manage it. Also, unique properties are farmland, vineyards, timberland. Anything that you are using for rental or business purposes does qualify for 1031 exchanges. Some of the best options I've found are mobile home parks. Now, my company, Patriot Holdings, invests in mobile home parks because we own the land. A land lease community allows for high profit margins. We do not own the mobile homes. So each tenant in the park pays their land lease, and then in turn, we're able to distribute larger cash flows as long as you buy the asset at a great basis. We also like self-storage facilities. These have higher profit margins as well because the buildings are made of metal roofs, concrete slabs, and pavement. So there's long-term low capital expenditures or low maintenance on the buildings. And as long as it's in a good location with little competition, we can keep the occupancy around 85% plus, and there's high cash flows, and the rents continue to increase over time as tenants continue to need to find places to put their stuff. Next is small bay industrial properties. These are properties that are 1,000 to 5,000 square foot tenants, and there's 20 to 50 units in a property. These are contractors, HVAC, plumbing, paving, roofing, all guys that are in the businesses that are home service based or inventory, supplies, materials needed, any of these things that need to be stored. These types of businesses need space to operate out of with an office, a bathroom, a roll-up door. Also, we have classic car guys. We have guys that are retired that just want to work on their cars out of these locations. Many different types of properties like the reduced rent under retail or office and the flexibility of having a warehouse, an office, and a bathroom. And the terms of the lease are flexible, anywhere between 1-year lease up to a 5 or 10-year lease. They're great properties to have a diversified stream of income where multiple tenants are paying the rents and you're not subject to one tenant leaving and destroying the cash flow on that property. These three assets have been high yielding, high cash flowing properties in the Patriot portfolio. Some other alternative structures are DSTs. These qualify as 1031 investment options, and tenant in common. That also qualifies as a 1031 investment option. A DST is typically an institutional grade asset where a investment company will bundle together large pieces of real estate, put them under a DST or Delaware statutory trust, and then a passive investor would sell real estate and invest in buying units in that trust, and that trust will distribute typically low dividends around 4 to 6%, and it would be a completely hands-off transaction, but they're able to defer their taxes and own a piece of a trust that has a lot of quality real estate. A tenant in common structure is where there's multiple owners on the deed of a property. This is beneficial because one of the owners can 1031 out of the tenant in common, and they can 1031 into a tenant in common. So it is not a partnership. You're a fractional owner of the deed of the real estate. It gives the flexibility of another partner to sell their tenant in common interest out of the partnership without having the 1031 exchange. So it offers maximum flexibility for multiple owners within a property where one person wants the 1031 exchange and another person wants to cash out of their investment. So what doesn't qualify? Well, like I said, primary residence. You cannot, or your immediate family cannot live in the residence that you are exchanging into. Second homes, the same thing. If you stay there for more than 14 days in a year and you don't rent it out, then you cannot use this as a 1031 exchange property. Flips, cannot flip into a 1031 exchange over and over. And partnership interests. You cannot invest into a LLC partnership where you're selling real estate and you're buying units into a fund, or you're buying units into a REIT, or you're buying units into a stock. Those things do not qualify, nor does crypto or any other non-traditional asset class. It's like-kind investment property for investment property. So what are some of the key rules? Well, number one, the 45-day identification period. You have to pick another property that you're going to buy within 45 days of selling the property that you sold. You can pick up to 3 choices, and you don't have to buy all 3, but one of those you must buy within a 180-day period. Now, it's not 45 days plus 180 days. It's 180 days total after you sell your property that you're exchanging out of. If you don't meet that timeline, you don't comply with the IRS statutes, and you will pay tax. Next is you want to use a qualified intermediary. This is a third party that's going to hold the money of your proceeds from the sale of your investment property. So your title or escrow company or your attorney handling the sale of your property is going to wire the funds to the QI. And that qualified intermediary is going to hold those funds and then invest those funds into the next property and fill out the paperwork for the IRS and then communicate with your CPA around tax time that they have the necessary paperwork that you're going to file so that you're compliant with the IRS statutes of the 1031 exchange. Now, check out the comments below. I did a video about how to choose the right QI. You do not want to get one where they own your funds. You want a separate account. It's a trust account or an escrow account that is dedicated to your name in a separate account in that structure so that you're protected if anything were to happen to that company. Last rule is when buying property in a 1031 exchange, make sure you exchange up. So you have to buy a property of equal or greater value. If you're selling a property for $1 million, you have to buy a property for at least $1 million or more. That is the rule. So if you don't buy up, then you will have to owe for tax. So now you know the ins and outs of a 1031 exchange and you know some investment vehicles to put it into. Check out this next video about how to invest with a 1031 exchange into real estate funds. This is a non-conventional strategy, but if you're an active investor that manages real estate and you want to be more of a passive investor and put your real estate into a high producing or high yielding fund, this is a great video for you. Check it out, and this will help you on your 1031 investing strategy.